Welcome to the SALT Basic video on income tax and property. Today's video we'll be discussing how property impacts your income tax return, negative gearing, depreciation, capital gains, tax effective structures, and what the foreign resident withholding capital gains tax means to you. So how does an investment property impact your tax return? Rent received in Australia is taxable income. This can be offset with a number of deductions including council rates, insurance, interest on loans, land tax, real estate agents fees, depreciation, repairs and maintenance, and some other small deductions. If the net result, once you've taken away the deductions from your income, is positive, this income is taxed at your marginal rate, which means it's added to the top of your other income. If the net result is a loss and the deductions are higher than your income, this will be deducted from your other income and can lead to a tax refund. Your other income is generally what you earn from a salary or wage job, dividends, bank interest, and any other business income you might have. Negative gearing is when you use a taxable loss inside your tax return from a rental property to earn a refund from the ATO and in turn reduce the amount of cash that the investment property will cost you. Property prices have been in the headlines in Melbourne and Sydney for a number of months now, and negative gearing has been a political football. So how does it work? When income received from rent is less than the allowable deductions, the loss of the rental income is a deduction against your other income. If you've got tax withheld from a salary or wage work position, this means that you will enjoy a tax refund from the loss that you've earned on the rental property. This improves your cash position, especially when we factor in non-cash deductions such as depreciation, which means that the tax loss is often greater than the cash loss. We've included a worked example here for you. As you can see, the yearly rent earned is $20,800. We have your stock standard deductions, which include council rates, water rates, agents fees, insurance, land tax, some small repairs and maintenance, interest on loans, and the special building write-off, which is a tax notional amount. This gives us a total expense of $28,987, meaning that the loss on the property for tax purposes is $8,187. If you look at the cash column, you'll notice that there is no dollar figure next to special building write-off. This is because this amount is worked out based on the build cost of the property and not a cash expense to you every year. The flow-on effect is that the actual cash cost of the property is $3,920. Once we factor in a refund based on 38% of tax of $3,111, this means that the property will cost this owner only $809 in physical cash during the year. Or, if we break that down weekly, $15 per week. As you can see from the worked example, depreciation, including the special building write-off, is very important, especially when you are negative gearing. This is because it will help improve your tax refund and make the property less of a cash burden to own. Similarly, if you are positively gearing the property and intend to make a profit out of the investment, this special building write-off and depreciation will reduce your tax liability. Essentially, depreciation is the dollar equivalent of the wear and tear of assets and the building itself. Recently, new laws have been introduced to limit depreciation. The new laws mean that you cannot claim depreciation on assets that were purchased with the property. Air conditioning, carpets, and ovens are an example of this, which may have been used by the owner that previously had the property before you purchased it. This is different if you're buying the property off the plan, and these are included inside that purchase. You can claim depreciation if you replace these assets or you purchase or install them as a separate asset after you've purchased the property. The special building write-off is not limited by these new law changes. The reason it is important to claim depreciation is that it must be added back at the eventual sale and capital gains calculation, regardless of whether you've claimed depreciation or not. Capital gains tax in Australia is separate to your income tax, although it must go in the same tax return. Profit from the sale of an investment property is taxable under the capital gains tax system. This profit can be offset by various costs, such as agent selling fees, solicitors' fees, stamp duty at purchase, and various adjustments at settlement. Because of this, record keeping is extremely important. A capital gain is taxed at your marginal rate of tax. This means that once the gain is calculated, it is added to your other income and then taxed at the rate of tax that you currently fall in. Any capital losses that you make on investment properties or other assets can be carried forward until a future capital gain is made. If the property is owned for longer than 12 months, you can receive discounting depending on the tax effective structure that you are using. Individual taxpayers will receive a 50% discount and self-managed super funds will receive a 1/3 discount. There are 4 main structures which taxpayers will generally buy property: either individually or as joint tenants, in a company, in a discretionary or unit trust, or in a self-managed super fund. This table summarises the differences between tax structures. The top line is the highest tax rate payable by each of the tax structures. An individual will have a maximum tax rate, including all surcharges, of 49%. A company will have a maximum tax rate of 30%. A trust will depend on where the beneficiary is being taxed. A super fund will have a maximum tax rate of 15%. The capital gains tax rate is also different across all of the entities. For an individual, it is the marginal rate. For a company, it is 30%. For a trust, it depends on the beneficiary. For a self-managed super fund, provided that you've owned the property for 12 months, it is 10%. The treatment of losses is also important to note, as it does differ between entities. In an individual situation, it can be offset against other income. This is known as negative gearing. In a company, it can also be offset against other income. In a trust, a loss is quarantined and cannot be distributed to beneficiaries and has little tax effect. In a self-managed super fund, it is difficult to have a loss as it is seen as a breach of the sole purpose test. Another thing to note is your ability to borrow. This changes depending on the entity that you choose to buy the property in, and you'll need to speak to either your bank or a mortgage broker to discuss further. For a detailed worked example on how the tax changes between different entities, please make an appointment with one of us here at Salt Financial Group. One of the recent law changes is the Foreign Resident Capital Gains Withholding Scheme. In our opinion, this is one of the most misleading titles that has ever been introduced into the tax system. This is because it relates to all residents, whether they are foreign or Australian, and it impacts sales of property regardless of the capital gain treatment. This tax law now captures all property purchases over $750,000. If a clearance certificate has not been obtained by the vendor and given to the purchaser at settlement date, the purchaser must remit 12.5% of the total purchase price before adjustments to the ATO. Please note that the onus is on the purchaser to send the funds to the ATO. Moreover, if the withholding amount is not paid to the ATO, then the purchaser is liable for this amount. Meaning that if the amount should have been withheld but it wasn't, you may be liable for an additional 12.5% on top of the purchase price to send to the ATO. If you are looking to buy a property or have recently purchased a property and it has not settled yet, please make sure you speak to your accountant and your conveyancer well before settlement to ensure that you have complied fully with this law change. Thank you for giving us a couple of minutes of your day to learn more about how investment properties can impact your tax return. If you have specific questions, please contact any one of us here at Salt Financial Group on the contact details at the bottom of your screen. Thank you.